Big IPO coming up, Robinhood. Robinhood is disrupting another stock market standard and taking a major risk by growing its access past Wall Street insiders and giving commoners access to a thick slice of an initial public offering, or an IPO. Robinhood, the traditional stock trading platform, which is somewhat controversial, is set to issue an IPO on July 29th, which could value the company at $35 billion. This IPO is one of the highly anticipated and 7th largest IPO in the USA this year. Thanks for joining us at Stacking Stocks, where we'll be talking about the Robinhood IPO and what effect it has on retail traders and how it affects the company itself. Now make sure to subscribe and hit the notification bell and never miss out on one of our videos. And with that out of the way, let's get started. Robinhood made its debut on Thursday, July 29th. The growing trading platform has given access to the new age of ordinary investors to financial markets all around the globe. But at the same time, it's profoundly controversial. Generally, only institutional investors and company insiders can buy shares in companies before they go public. But Robinhood is making an unusual stride by allowing clients of its platform to buy up to a third of its IPO shares before they start exchanging under the HOOD ticker symbol. IPO experts and investors are watching Robinhood's first day of trade on the NASDAQ closely. A large part of the interest is because of the surprising feature of Robinhood's IPO. The trading platform put away up to 35% of shares for individual investors on its stage, an enormous lump of stock that could fuel initial instability. Robinhood will exchange at a normal price of $38 to $42 per share. Robinhood is hoping to sell 55 million shares at that range to collect as much as $2.3 billion. Early access can conceivably give investors a major benefit if shares move higher once they're out. As per Renaissance Capital, between 2001 and 2020, the normal U.S. IPO returned 14.5% from the share price on day one. So far this year, the leap is much higher, at 34%. This year, the average first-day return for IPOs that have raised no less than $100 million is 25%. The Menlo Park, California company hopes to put forward up to $770 million worth of its shares to its clients. The estimate depends on an offering price of around $40 per share, which is the midpoint in a range of $38 to $42 per share. This is what the company said in a filing with the Securities and Exchange Commission last week. By and large, Robinhood is looking for a market valuation of up to $35 billion. While offering retail traders a chance at pre-IPO shares is uncommon, there have been some prominent examples in recent years. Robinhood is making accessible an enormous piece of its shares to clients by using its own exchanging stage. The move could misfire if numerous retail traders flip their shares for a quick gain rather than holding them, said Matt Kennedy, who's a senior IPO market strategist at Renaissance Capital. The major downside, he says, and the reason this is so unusual, is that issuers typically place a great deal of value on the investment bank's ability to place the shares with institutional, long-only investors who understand the business and believe in it and have done their homework. He also goes on to say, retail traders have more of a reputation of flipping, so this could result in higher volatility. Ride-hailing apps like Uber and Lyft gave their drivers an approach to purchase IPO shares, while Etsy let its users get a slice of its IPO. A few organizations likewise choose to open up to the world utilizing what's known as a direct listing. A direct listing is where a company sells its shares to the general population without including underwriters. In this way, everybody's on equal footing. Robinhood's approach stands out mainly because it's setting aside up to 35% of the IPO shares for its users. That's the largest portion by far of pre-IPO shares to be designated for retail investors in an underwritten offering, is what Matt Kennedy says. Now, Robinhood recently unfolded IPO Access. It's a stage that permits clients to get in ahead of time in IPOs. Now, the first such IPO made open to Robinhood customers was Fig's stock market debut in May. It took off by 36% on the first day of trade. Robinhood has cautioned that clients of IPO Access might get the full number of shares they want, or an incomplete amount, or none based upon demand and other elements. Robinhood is cautioning its users from flipping shares they purchased through its IPO stage. The company cautions that users who sell IPO shares within 30 days of the IPO will be limited from purchasing shares in IPOs for 60 days. And that might clarify the two-dimensional methodology that Robinhood user Alan Tran of New York is taking. The 23-year-old, who started using Robinhood in 2016, has online networks of investors. He says he's signed up for Robinhood's IPO stage and plans to purchase a share of the company and hold them for a very long time. Tran likewise plans to utilize another exchanging stage to purchase shares in Robinhood once they make their debut, and afterwards scalp or sell those immediately to benefit from what he expects will be a major first-day fly in the stock. "I'm going to watch the stock rally with hype, then I'm going to get out relatively quickly, banking my profits," Tran said. But when asked what he would do if the stock should open beneath its offering price, he stated, "I would be very, very surprised if that happens. If that does happen, that just means that I'll be able to buy more shares with the same amount of capital." Will common investors and Wall Street betting types that are still furious over this GameStop trading fiasco in January attempt to get revenge from Robinhood? Shorting the stock in any huge way, some say, would be troublesome and costly. Robinhood itself cautioned that its shares could go through some volatility as a meme stock, specifically because it's holding an uncommonly enormous tranche of shares for individual investors and their own customers. R.A. Faroknia, a professor at Columbia Business School and executive director of the Columbia FinTech Initiative, said, "As I review, there has not been an organization doing what Robinhood is intending to do at the extent they're wanting to do it." He added that if the approach doesn't go safely, Robinhood would be in uncharted regulatory territory at a time when the organization is already in the eye of regulatory bodies. If you're looking from a higher perspective, Robinhood's mission of issuing the IPO is to democratize financial markets. As Parina Agarwal, a professor of finance at Georgetown University, up to 85% of IPO shares will go to institutional investors like hedge funds and money managers. The remainder is allocated to individual investors, but banks often distribute them among their high net worth clients. IPOs haven't been allocated to retail investors in a big way, she added. That makes these investors out of luck when new stocks experience a common pop on the first day of trading, accenting at a price above its offering cost. If you use Robinhood, that would not be an issue for you. However, the size of the company's retail allotment is making heaps of vulnerability. Robinhood will develop generosity with customers and rustle up exposure for its IPO product if the effort moves along as expected. But in case there are technical glitches or different issues, Robinhood could be in for a ton of misfortune. Well, that's a wrap for today's video. With all this information, do you think investing in Robinhood IPO is a good decision? Let me know in the comments section below. If you enjoyed the video, make sure to give it a like and subscribe. We'll see you next time on Stacking Stocks.